The turbulent economic headwinds have prompted many a wise investor to both reassess the market holistically and their own portfolio. It is optimal from time to time to review one's strategy and capital allocation to ensure financial long-term health, akin to cutting off one's hand to save the body as a whole. In this video, I'm going to deep dive into the health of my personal portfolio, break down the stocks that I've recently sold to ensure I'm maintaining an optimal investing strategy geared towards growth in the future. Starting with Kroger, ticker symbol KR, which I offloaded 6 shares of in August. I made a slight profit on the deal, but this is incidental to the reason why I sold it. I first bought Kroger in August 2022, known as a solid dividend payer, and had a healthy growth trajectory. With the announcement of the merger with the other grocery chain Albertsons, I thought this would lead to enhanced growth, but this failed to materialize. The stock price tanked after the deal and is now somewhat recovering, but I do not see a path to the required growth I am looking for, and therefore reallocated my capital elsewhere. A few other metrics that are red flags to me with Kroger are the low 2.2% dividend yield and the failing profit margin of the company at 6.27%. Many of you won't know this company, but the next stock I sold off was Amcor, ticker symbol AMCR. Amcor is a packaging company based in the UK with about 41,000 employees. I bought this stock when I was relatively new to dividend investing, and in truth, due to its attractive yield at 8.43% and cheap price at $12 a share at the time. Luckily, I only bought 4 shares and I sold at a loss last month. This stock seems like a bit of a classic dividend trap, a high yield to draw people in, but low, if not negative growth. I did receive a good few dividend payments through the quarters to offset the loss, but a loss nonetheless. 2 things stand out to me about Amcor in hindsight now. Very low profit margin at 5.53% and a large debt to equity ratio at 1.67% given the type of company it is. I would be wary of this stock when evaluating options for a dividend portfolio. I hold a substantial amount of WBA stock, Walgreens Boots Alliance, standing at 37 shares to the value of $760. Looking at the 1-year chart here of WBA over the last year, you can see the stock is down almost 40%. However, it may come as a surprise that I'm not selling this stock, nor am I particularly worried about the steep decline in the stock price. WBA stock price was artificially inflated during the pandemic due to vaccines and medication sales. It is an expected correction for the price to come down now post-pandemic. My thesis on the stock is it sells staple goods and services that will always be needed. They are also very dominant in the US and the European market. The company really just needs fresh leadership and a return to what has worked for them in the past. Luckily, they have just appointed a new CEO and to what I imagine will put the ship back on course. This has already prompted the likes of JP Morgan to upgrade the stock to a buy as the company draws back some of the losses with their latest earnings. The fundamentals of the company are strong, with a manageable debt to equity ratio of 0.5, a reasonable cash flow in the last 3 years, and a dividend yield at 8.94%. The only red flag I would highlight is the low profit margin at 3.3%. This definitely needs some work from a strategic perspective at the management level. Some of this can be equated to the high level of competition in the industry. But all in all, I'm still buying and I project a good return over the next decade for those of us buying low now and then holding. I wanted to walk through the landscape as it relates to Apple at the moment, as it seems to be in the headlines a lot in a particularly negative light. I hold some Apple stock and I'm not intending on selling it anytime soon. It almost seems as if the shine on the crown of Apple is starting to dim, with the lackluster annual event this year and poor response to the new iPhone and Vision Pro alongside the company's issues in China, primarily moving their manufacturing to other countries. It seems Apple doesn't appear as sturdy as it once did. However, in my opinion, this is just a result of the geopolitical landscape that we find ourselves in today, alongside the uncertain economic position. As the great Warren Buffett once said, be fearful when others are greedy, and to be greedy only when others are fearful. To conclude, I believe it is optimal to reassess your portfolio at least once a year and really dig down deep on the various theses on each of your stock, ETFs and bonds, etc. Does your strategy/tactics still hold through? If not, is it wise to create a new plan and then iterate? The funds I gained from these sales have mainly been reallocated to Coca-Cola, Realty Income, and a new tactic of purchasing my first ETF, Vanguard's S&P 500 ETF VUSA. as I believe greater returns and growth lie there, alongside some de-risking in the form of the ETF purchase. Leave your questions and comments below and catch you in the next one.